Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem related to a consolidation where we have a 100% owned subsidiary. We will be dealing with goodwill with regards to that consolidation, where the fair value is going to be different for the property, plant, and equipment from the book value, accounting for that. There also will be an impairment of goodwill that we will have to deal with at the date of consolidation. We're going to say that the purchase took place in January, a year later, and we're going to be doing the consolidation a year after that. Therefore, a year of activity will be there. We will have income statement accounts, revenue and expense accounts to deal with during this consolidation. Get ready to account with Advanced Financial Accounting. Here we are in our Excel worksheet. We have our information on the left. We're going to be entering that information into the blue area on the bottom and to the right. Then we've got our consolidation worksheet where we have company P's trial balance after a year later, after the point of the purchase took place, and S, of course. We're going to be consolidating them together and then entering our consolidation or elimination entries. Going back to the left to see the data, we have P purchased 100% of S outstanding common stock. P the parent, S the subsidiary, for $109,000. So $109,000 purchase. Fair value of the building was higher than the book by the $18,000. Okay, so purchase took place. The purchase took place a year ago. So we can't take just the assets minus liabilities of S in this trial balance, that's being a year later at this point. But if we were to do that for a year ago, and take the assets minus the liabilities, or simply the equity section at that point in time, we would get, that the book value at that point. And so we're saying that a year ago, if we were to do that, all of the assets minus the liabilities, fair value equals the book value, except for the exception I believe we just said was the building here, which was $18,000 more. So it's 161 here. It was $18,000 more. So we're going to have to account for that. So we'll deal with that. Depreciation, depreciable assets depreciated on a 10-year basis. Now note that what we've seen in the past is we've seen, okay, well, if that happens, all we're going to do then is we're going to say that we will, when we consolidate, we'll just increase the building by that amount, by that 18,000 in the consolidation, no problem. However, but what do we do with the depreciation? Because if it's $18,000 higher, then like a year later, if we record that in the consolidation, we're going to have to depreciate it. And so we'll have to deal with depreciation. So again, complications adding up here. So, okay. And then we have the goodwill was impaired and has a carrying value of $2,300. So we're going to have to calculate goodwill. We're going to add goodwill. Then they need to test for goodwill, because we're not just going to amortize it similar to depreciation, but rather test for it to see if there's impairment. Then we'll decrease it if there is. The trial balance as of the end of the year are here. So there's P and S a year later, so after the purchase took place. All right, let's first do a calculation for goodwill and to see what that looks like. So the purchase happened we say the purchase was for the 109. So what we need to do then is be comparing basically the fair value of S's books to the purchase price. How do we know what the fair value was? If I look at these books over here, and obviously in real life, we would have the balance sheet, we would have the numbers from a year ago when the actual purchase took place. But here, in a book problem, they might just give us the ending year numbers. And I'm going to go, well, how do I know, how can I calculate goodwill when I need the trial balance a year ago? Well, I can't just say assets minus liabilities, because there's a year's worth of data. What I can do, however, since it's only been 1 year, and if they happen to give me 1 year of data a year later, I can say, well, the common stock hasn't changed and the retained earnings hasn't changed, because the retained earnings, nothing has been closed out to it. The income accounts aren't closed out to it. Dividends are not included in this retained earnings because they're broken out separately here. Therefore, these two accounts represent the equity, which also, of course, represents assets minus liabilities for the prior year. So this is a way a book problem can give you, an added kind of trick that you have to basically figure out given the data that's been given here. In real life, you'd probably just pull the last year's trial balance. So I'm going to say, all right, well, that means that the book value last year was going to be the negative sum. I'm going to say negative sum of, okay, I still didn't do it right. The negative sum of these two, common stock and retained earnings. All right, so there is that. And then I'm going to say that there was a difference. We said that there was an increase in the machinery and equipment. So 161, it needed to increase at the point in time that we purchased it. So we're going to say that was higher by 18,000 we determined. So 18,000 higher fair value. That means the fair value is what the assets minus liabilities were on a book basis plus that 18,000 difference for the machinery and equipment. Now we paid 109,000 after revaluing last year for the purchase date. It was only 100,000. Therefore, the difference represents something that wasn't included over here, an intangible that assumed to be goodwill. So there's our goodwill calculation. All right, now let's do our consolidation up top. Knowing that information, let's go, okay, let's do our consolidation over here. Standard consolidation. Here's the P's trial balance. Here's S's trial balance. Let's add them together so that we can do that. So I'm just going to sum up these two just like we've done before. I'm doing this with the keyboard more these days just because we're going to practice the keyboard. I'm hitting the down arrow shift. I'm holding down shift, scrolling down, and then I'm going to go all the way down here and then Control V, pasting that. So there we have our numbers. Then I'm going to go back up top and we're going to say, all right, now let's consider our adjusting entries. So we got to remove, you'll recall, of course, this number. That number needs to go away. How did that number get there? It's useful to see the equity method, which is the typical method that's going to be used. We're going to say, all right, how did that number get there? Well, if I think about the equity method, it's only been 1 year. So when they purchased it, they paid, we're going to assume cash, 109,000, investment on the books, 109,000. That's data up here, was paid for. So that's the first number. Then we saw that S earned 35,000, which is fully owned by P. Therefore, P increased their investment account by the 35 and income from S. So there's the income from S right there. And then we see that S issued a dividend to 34,500 to its shareholders, of which P owns all shares. Therefore, that 34,500 cash to P ultimately, and they credit the investment, so that 109,500 represents this plus this minus that. Okay, now that we know that, we could go back up top and start building our journal entry. Now, I'm not going to do this kind of two-step process we did before. I'm going to do basically our elimination journal entry where I'm going to say, I'm just going to lump everything together now because I think that's actually easier to do. So what I'm going to do is I'm going to say, all right, there's the 109. I know that has to go away. There's the income account there. I know that has to go away. And these equity accounts for S, I know they have to go away. So let's do that and see what happens, see what we're left with here. That's how I would basically think of this normally. I would say, okay, let's just do this all in one lump sum. I know that this investment account here, I know that's got to go away. And so that's going to be negative of the 109. So that 109, I know that's got to go away. And then I know these equity accounts down here, I know that they need to go away. Now, it's not going to work out perfectly, I understand, because there was goodwill involved here and a revaluation of the assets. So so that should all be in consideration with this long journal entry. So I'm going to say, all right, so I know that the common stock for S needs to go away, and I know that the retained earnings for S needs to go away, and I know that the dividends for S need to go away. So those things I know. So this is a credit balance, so I'm going to go ahead and debit it. So in the common stock, I'm going to say negative of that credit, so we'll debit that. The retained earnings, I'm going to say negative of that 31. Get rid of that. This is a debit here, so to make it go away, I'm going to credit it. So I'm going to say that's on the credit side, negative of that 34.5. Get rid of that. So I've removed basically the equity section here. I also need to remove kind of like the income section, but I'm not going to remove the detail because it's recorded twice, right? It's recorded here at the 35,000 and it's recorded here at the 35,000. I want the detail, so I'm going to remove the one line item recorded here. This account needs to go away, so I'm going to say I know that's got to go away. Clearly, I can't have an income statement account going to ourselves if we're a consolidation. So I'm going to say, all right, that's got to go. That's got to go. So we're going to say that's going to be the debit here to get it away because it's a credit. So we need to remove it by doing the opposite thing to it, which is a debit. Now, if I was to think about, the transaction thus far, notice it doesn't add up thus far, right? So if I was to highlight that, we're out of balance. Now, if we had a problem where we didn't have goodwill and the purchase took place for the book value and we had no revaluations here, then that would basically tie out. But we do have those problems here. So the reason it doesn't tie out then is I'm going to say now, we got to account for the fact that there was machinery and equipment that went on the books that we adjusted for. So this 109, that included this investment down here, needs to be adjusted for the fact that the goodwill and the adjustment to the fair value of the assets. So this machinery and equipment, in other words, we need to increase it by the 18 because that's part of basically this purchase price down here. That's part of the purchase price, which is part of this number. So I'm going to say, all right, this needs to go up by 18 so that we record the machinery and equipment basically at fair value at the point in time of purchase. And so that still doesn't do it, though. That still doesn't do it. So now we've kind of fair valued everything. We're off by 9,000. Well, what's the 9,000? That's the goodwill. So we're going to say, all right, now there's also goodwill that we need to account for, representing, once again, on this first transaction, the 109 that we paid over even the fair value of the assets. So we're going to have to say, all right, goodwill's on the books, and I'm just going to say negative sum here. Negative sum, here's the plug for goodwill. So to me, to build this journal entry, I think it's easiest to do really with one long journal entry with the bottom line plug being goodwill, because everything else you kind of know. Like I know that's got to go away. I know that's got to go away. I know that's got to go away. That's got to go away. I know that's got to go away. I know this is an adjustment that happened, and that's going to be an adjustment every time at the point in time of purchase. The difference then should be the goodwill. That's how I would mostly think about it. You end up with this one long journal entry that way. So in any case, let's go ahead and post it out and say, all right, does that work? Let's check it out. Investment, let's go into the investment over here. So this investment account, it needs to go. So I'm going to say that's going to be a 109. Does this do what I expect? Does it go down to 0? It does. All right. And then the common stock, same process that we've seen in the past. Common stock for S. I'm in L14 equals. Going to scroll up to that 51,000 and enter. So here's P's amount. There's S. There's the sum of the two. Removed S back to the P amount, just like we've seen in the past. Retained earnings, same thing. Going back down, we're going to record the retained earnings equals. We're going to be putting in that 31. And there we have it. So here is P's, here's S, there's the total, minus S brings us back to P. And then we'll do the dividends, same kind of process. So I'm going to say, all right, dividends, we could do that one. So that equals, and we're going to go up to that 34.5, the 34.5 up top. And once again, we have, okay, there's P, there's S, there's the sum of them. We removed S, bringing us back to P. All right, and then we've got the income from S. Income from S, that's got to go away down here, just as we've seen in the past. So there's the 35,000. So I'm going to say equals. We're going to scroll up to that income from S, and then it goes to 0. And then we have to increase the amount of the building, because the building at the point of purchase was higher on a fair value, and when we consolidate them, we kind of have we're representing it kind of like a purchase took place, so we need to increase the building to fair value. So I'm going to go over and say, all right, the building needs to go up by the 18,000. And then, even though we fair valued everything, we still didn't pay the same amount because there's something on the books that wasn't, accounted for, and that's goodwill. So we know this is intangible asset of goodwill that's going on the books then. So we'll pick up the intangible asset of goodwill, and there we have it. All right, so that looks good. Now, note that we have an added problem. It's been a year since this 18,000 that we said the value of the machinery and equipment was higher by 18,000. Well, what happens a year later? Because we have to depreciate the machinery and equipment, right? So now we got to calculate the depreciation. Now, in practice, this might be more difficult because obviously, when you think about this valuation of an increase in the machinery and building or whatever, you then have to think about each individual piece of building and machinery to think about the depreciation that you're going to apply to each of them, right? So that's going to be more complex. But just in theory, of course, we'd say, okay, we revalued this whole, whatever's included here, building and the machinery. And it's a year later, so we're gonna have to add the depreciation for the current year that was calculated on it. So I'm gonna say, all right, well, that's the normal depreciation entry is gonna be the depreciation expense. So I know I'm gonna debit depreciation expense and credit accumulated depreciation. So that the accounts affected are not difficult. The calculation in practice would be more difficult. We're going to simplify the calculation. We're just going to say, all right, that's just going to be the 18,000. We'll assume it's 10-year property divided by 10, and that's it. But again, that's simplified. Just note that, I mean, in practice, you'd have to look at the depreciation schedule for all the depreciable assets and then figure out what depreciation you're going to tie to that added increase that you increased at the point of purchase, most likely. So the calculation could be quite more complex, but in theory, you get what we mean here. We said, okay, well, if you increase the value of the machinery and equipment, then you're going to have to depreciate the value because that's what we do with machinery and equipment. All right, so then we're going to record that. Depreciation expense down here is going to then be debited. So we will debit the depreciation expense. So there we have that, increasing that, and then we're going to credit the accumulated depreciation. So we're going to credit that equals the credit to the accumulated depreciation. Okay, so there we have that. Now we also have that standard thing where we had the goodwill, where we had the depreciation, accumulated depreciation that we want to net into the book value. So that's different than this depreciation entry. In this depreciation entry, we revalued the assets and then recorded the depreciation based on the added 18. Here, we're just doing the normal thing we've seen in the past, which is we need to take the accumulated depreciation that was there at the point of purchase, net it into the building and equipment. So it's been a year later. It wasn't 24,000 at the point of purchase, but we could do that thing because it's only been 1 year. We could see the depreciation expense before we recorded this 1,008 was recorded by S at 10,000. So, and now there's 24,000. So the difference between the two must be the amount that was in accumulated depreciation at the point of the purchase. So we're going to do our standard transaction there. We're going to say, all right, there's our standard transaction was to say accumulated depreciation. We're going to decrease that by, I'm going to say negative brackets of this amount plus this amount. And obviously, and again, this is another area in real life, we would just be picking up this amount most likely from the financial statements at the point in time of the consolidation rather than backing into it with these numbers that are from a year later. But a book problem could very likely give you some kind of little tricky calculation like this, and that helps to test you on being able to figure things out that are strange. Then we're going to say the other side is going to be the building and machinery, and there we have that. So let's go ahead and net that out. We've seen this in the past, so we're going to go to the accumulated depreciation. Now there's something in it already, and these two transactions don't have anything to do. They're separate kind of things. We talked about that, but I'm going to go into it then. F2 plus F2, and then we'll pick up that 14. So, that's the wrong one. Messed it up. Undo. Try it again. F2 plus F2, and then we want the number, not the account name. And then I'm going to pick up the building and machinery up top. And I'm in L7, F2 plus F2. Scrolling back down to that 14,000. So there we have that. We've netted that out. All right, one more thing that they said, that we put the goodwill on the books at the 9,000. We don't just amortize that now as an intangible, like depreciating it. We rather have to test whether or not it's been impaired periodically, such as typically yearly. So we're going to say, okay, now it's been impaired. We're going to say that goodwill has been impaired, meaning at the point in time of purchase, we figured that the goodwill calculation was there. We think it's gone down now. So possibly we've done things to tarnish the name of the brand or whatever, something like that. You know, goodwill is lower. All right, so then we're going to have to say goodwill was impaired and has a carrying value of 2,300. So if it says that we calculate the carrying value to be the 2,300, then we're going to need to make this number be the 2,300, which means we have to subtract the 9,000 minus the 2,300 to adjust this to be the carrying value 2,300. So this is a debit. We're going to have to credit it, and the difference is going to go down to an expense account, which is just going to be, you know, there's an impairment down here, goodwill impairment loss. All right, so we're going to have to decrease an asset, and we've consumed it. And a good way to think about goodwill, notice goodwill is the brand name. So if there was a consolidation between like S and P, and part of what was purchased was the brand name, you know, one way P can basically cash in on their purchase of S is to basically not keep up to the standards of S, right? Which means that their brand name will go down, but their short-term revenues will go up, most likely, right? So it's quite possible that, you know, that's one thing that you could think about. Well, if goodwill is going down, what does that mean? It could mean that the company is cashing in on the brand name by possibly not keeping up the same standard of goods or services that were established by the prior company, which is creating short-term profits at the cost of the goodwill that they purchased. So they're basically, if that were to be the case, they would basically just be cashing in the goodwill. They would be charging more for the goods or services than they're worth because they're not keeping up to the standard that was there before, and that would just, and so if you think about it that way, then notice if that worked out the way it should, then that would make sense, right? You're going to say there's the goodwill on the books, it's worth something, and then if something got impaired in the future in terms of the quality being less, then of course the brand name is the thing that suffers. That asset would then be going down. It would be cashed in. It would be cashed in by basically, not keeping the standard or something like that. So in any case, we're going to say the goodwill is going to be equal to the 9,000 minus what we think it is now, the 2,300. So 6,700. And then the other side, the other side should be in goodwill here. So this is the impairment. The top account is the impairment. And then goodwill. So if we record this, then we're going to have kind of like an expense, a loss over here of the goodwill. I've already got it recorded. Let's do it again. So I'm going to equals this 6,700. And then the other side is going to be going into the goodwill, the asset. So we're going to scroll back up top. And something's in it. I'm going to say F2 plus F2. And then let's credit that goodwill, bringing it down to the carrying value of the 2,300. So here's our ending numbers here. So we've just been adding, some levels of complication, just different types of things that could be in a complication. So we could focus in on that. If we were to consolidate this, fairly straightforward consolidation. However, we revalue the machinery and equipment and the depreciation, but the reporting is fairly straightforward. The goodwill now on the books at the carrying value. And everything else is fairly straightforward because we don't have any minority interest, which is usually the thing that complicates basically the equity section. So once you do the consolidation, in other words, then converting that trial balance to the balance sheet, nothing too unusual for it. That's it.